We are entering the second half of 2026 with an economy quietly stalling out. Beneath the surface, the macroeconomic baseline is surprisingly fragile. Recent conflicts in the Gulf spiked oil prices, acting as a massive, invisible global tax on the system. Those inflated energy costs successfully drained available cash flow, pulling vital liquidity completely out of the broader economy. With economic weakness spreading, you might expect rate cuts. Yet there is surprisingly little pressure on the U.S. Federal Reserve to lower interest rates right now. This dynamic holds the U.S. dollar relatively strong, actively suppressing the price of dollar-denominated assets like gold and copper. We are left with a dangerous baseline. Capital markets are entirely starved for cash, while the cost of borrowing remains stubbornly high. This line tracks the yield curve, the ultimate warning indicator for the economy. The government is desperately trying to manipulate it, issuing one-year paper to buy back long-term debt to force yields down. But the market rejects the maneuver. Long-term yields stubbornly rise. Investors are looking at the broad economy and demanding a severe time premium and risk premium just to hold government debt. When interest rates relentlessly push higher against the government's intervention, it sets the exact stage for a catastrophic fracture in the credit system. That fracture is likely to begin in high-yield subprime credit ETFs. Trillions of retail dollars are trapped in these funds, held by investors who do not truly grasp the risk profile they own. The catalyst is straightforward. As interest rates jump, from 7% to 9%, for example, heavily stressed corporate borrowers will lose their ability to pay and begin to default. This diagram illustrates a fatal structural mismatch at the core of these funds. The ETF structure itself appears highly liquid, but the underlying junk bonds are incredibly illiquid. Some of these bonds only trade over the counter once every 6 weeks. If panicked retail investors hit sell, managers must immediately fund those redemptions. They will be forced to fire sell these illiquid bonds into a distressed, buyerless market, securing prices that reflect absolute panic. This chain reaction creates a rapid, unstoppable run on the bank, playing out entirely within the shadow banking sector. And unlike traditional banking panics, retail investors caught in this ETF credit collapse have no FDIC backstop to save them from total loss. We saw a similar systemic threat in 2008. Back then, the entire structure survived solely because government stepped in to forcefully backstop failing institutions. These side-by-side charts highlight a critical difference. In 2008, the aggregate debt of the U.S. federal government was about 40% of GDP. Today, that on-balance sheet debt sits at 120%. At this ratio, there is no fiscal headroom. The government cannot realistically raise taxes or expand the deficit enough to simply borrow the money required for a bailout. To save the system today, the Federal Reserve faces an impossible dilemma. They would be forced to completely monetize the debt, printing trillions of dollars out of thin air. Executing a rescue at that scale would unleash wild inflation, destroying both global confidence in the U.S. dollar and the credit markets themselves. Because the Fed's traditional rescue tools are broken, capital must proactively locate safe harbor long before the fracture occurs. To mount a strong defense, capital abandons paper promises and seeks refuge in tangible, value-driven natural resources. Currently, gold stocks are trading at relatively fair prices compared to the metal. This presents a rare buying opportunity before nominal gold prices rise markedly over the next decade. A counterintuitive opportunity exists in the oil and gas sector, particularly in Canada, where the market is currently in freefall and heavily discounted. Despite domestic political hostility toward fossil fuels, the fiscal arithmetic secures the opportunity. Governments absolutely require massive resource revenues just to fund their social programs. Within these constrained environments, royalty and streaming companies thrive. Because they enjoy significantly lower capital costs than traditional miners, they excel at financing projects, even when broader interest rates punish the rest of the market. Surviving a macro collapse requires ignoring emotional market panic and instead embracing rational, long-term valuation in temporarily distressed sectors. However, executing this strategy requires uncompromising standards. In the junior resource space, roughly 85% of companies are completely valueless and must be discarded immediately. To find the viable 2%, apply a strict survival criteria. First, the management team must have a proven track record that applies directly to the specific geography and geological task at hand. Second is massive scale. The target must be a Tier 1 deposit holding a minimum of $10 billion in in-situ value and capable of operating in the lowest cost quartile. Third is capital resilience. A company must maintain at least an 18-month funded runway, proving they raised their cash when markets were easy, not when they were desperate. The final test requires management to define the one technical hurdle currently suppressing the project's valuation. They must demonstrate how their specific exploration plan will provide the evidence needed to resolve it. In a high-risk, heavily indebted economy, true alpha is not found by waiting for macroeconomic certainty. It is generated through ruthless, micro-level diligence.